Today, we're not talking about money management, we're not talking about saving habits, we're not talking about cutting expenses. We're talking about something bigger, something stronger, something that separates people who just earn money from people who build wealth. And that is an investment plan. Not random investing, not hype investing, not gambling in the market. I'm talking about a clear, thoughtful, intentional investment strategy designed with purpose, discipline, patience, and vision. Because money doesn't grow just by working hard. Money grows when it is placed in the right direction, for a long enough time with the right mindset, and that mindset is what we're going to build today. Chapter 1. Investment is a vision, not a shortcut. Most people don't invest to build wealth. They invest because they want to get rich fast. They're not chasing financial security, they're chasing a quick outcome. And that's why they quit when the market drops, the portfolio turns red, impatience kicks in. But real investing is not about speed. It's about direction. It is about saying, I don't want to be rich tomorrow. I want to be financially free 10 years from now. Because investment is not a sprint, it is a lifelong commitment to growth. We don't invest for excitement. We invest for stability, dignity, freedom, and time. That's what separates speculators from investors. Speculators chase noise. Investors build vision. And every strong investment plan begins with one question. What future am I building toward? Not this month, not this year, but the life 10 to 20 years ahead. Chapter 2. Never invest blind. Invest with a thesis. Smart investors don't ask, where should I invest? They ask, why should I invest here? Every investment should have a thesis behind it, a reason, a logic, a conviction. Before you put money anywhere, ask, what real-world problem does this company or asset solve? Where does its growth come from? Is the market expanding or shrinking? What competitive edge exists? Is there real demand or just hype? Because if there is no thesis, you are not investing, you are gambling. A strong thesis gives you confidence during volatility, patience during downturns, conviction to hold long-term without a thesis. Every dip feels like danger and every rise feels like temptation. With a thesis, every dip becomes opportunity and every rise becomes validation. Investing blind costs money. Investing with understanding builds wealth. Chapter 3. You don't beat the market, you survive it. The market has moods. It breathes, it rises, it falls, it shakes people out. And most people lose money not because the market failed, but because they broke before the market recovered. True investors know bull runs don't last forever, crashes don't last forever, fear doesn't last forever, hype doesn't last forever. There are moments where everything looks perfect, and there are moments where everything looks broken. And yet, the world keeps moving. Innovation continues. Businesses rebuild. Economies reshape. Real investors don't panic sell because they understand markets don't collapse. They correct, they reset, they test conviction. And the people who remain calm through uncertainty are the ones who walk out stronger. You don't win by timing every cycle, you win by surviving every cycle. Chapter 4. Diversification is protection, not decoration. A strong investment plan is never built on one asset, one sector, or one idea. Putting everything in one single place isn't courage, it's vulnerability. Diversification is not for people who are scared, it is for people who are strategic. A mature portfolio spreads intention across growth assets, stability assets, cash opportunities, inflation protection. Because life doesn't move at one speed. Your income won't grow at one pace. The economy won't move in one direction. Opportunities won't arrive at one time. So your investments shouldn't sit in one bucket either. Diversification is not about maximizing returns. It is about protecting your future from uncertainty. Chapter 5. Time in the market beats. Timing. The market. People love asking, when is the best time to buy? When will prices drop? When is the perfect entry? But the real question is, how long are you willing to stay invested? Because an early entry may give profit, a discounted entry may feel good, but long-term participation builds wealth. Time changes everything. It turns volatility into opportunity, it turns learning into wisdom, it turns compounding into strength. Compounding is not magic. It is the reward for patience. The market doesn't pay people who want quick results. It rewards people who stay. And time has always been the greatest multiplier. Chapter 6. Your risk profile is your real identity. Two people can invest in the same asset. One will panic, the other will sleep peacefully. The difference is not in the investment, it is in the personality. Risk tolerance is deeply personal. Some people prefer slow, steady growth. Some can handle volatility confidently. Some become anxious during drawdowns. A good investment plan doesn't copy trends. It respects your temperament, your stress, limits your emotional endurance. Because the best portfolio isn't the one with highest return. It is the one you can hold without losing peace of mind. Investing is not just numbers, it is psychology. Chapter 7. Every investment needs an exit logic. Everyone plans entries, few people plan exits. Before entering any investment, decide, under what conditions will I hold long term? Under what conditions will I take profit? Under what conditions will I accept loss? Because investment is not attachment, it is strategy. You are not married to an asset. Your loyalty is to your goals, your discipline, your long-term vision. Exits are not emotional decisions. They are predefined rules, and rules protect you from impulsive behavior. Chapter 8. Reinvesting. Gains is what builds real wealth. Taking profit and spending it feels satisfying, but it doesn't build strength. The real turning point in wealth happens when profits stop being consumption and start becoming reinvestment. That is when money stops working for you and starts hiring more money to work with it. This is the moment your capital stops being money and starts becoming a wealth engine. That is compounding in its pure form. The goal is not just profit, the goal is capital expansion. Chapter 9. Your portfolio should follow your life stages. A mature investment plan evolves with your life. Your portfolio in your 20s should not look like your portfolio in your 50s. Because your priorities shift, early life is about growth potential, midlife is about balance and security, later years are about capital protection. An investment plan should move with you. It should support your responsibilities, your commitments, your future obligations. The goal is not to chase wealth endlessly. The goal is to align wealth with life. Chapter 10. We don't invest for luxury. We invest for freedom. At the end of the day, we don't build an investment plan to show success. We build it to experience freedom. Freedom from stress, freedom from dependency, freedom from uncertainty, freedom to choose how to live. Investment isn't about status, it's about control over time and choices. It gives you the ability to say, I don't have to rush. I don't have to fear the future. I can live with dignity. That is the real purpose of investing. Not excitement, not greed, but freedom. Closing message. An investment plan is not a chart, not a trick, not a quick win. It is a combination of discipline, understanding, conviction, patience, self-control. And the people who master these don't just build wealth, they build stability, security, and legacy. Thank you for watching. If you found this video helpful, make sure to like and share it, and don't forget to subscribe to Money Mind Professor to become a part of our financial learning journey. Here we talk about saving smarter, investing wisely, improving your business, and developing a strong money mindset. Share your thoughts and questions in the comments. I'll see you in the next video. Stay focused, stay consistent, and stay financially smart.